Hi, my name is Adam Whitmer and I'm your host here at ComplianceCohort.com. This compliance clip is going to talk about closing a loan with force-placed flood insurance. So let's dive in and maybe make a splash on this compliance topic. So, the challenge here with force-placed insurance is that over the last decade or so, we have seen significant changes to the existing flood insurance rules. And in 2012 specifically, we saw the Bigger Waters Flood Insurance Reform Act come along and make a number of significant changes. One of the biggest changes that affected your customers had to do with the cost of the cost of flood insurance policies. So ultimately what happened was the flood insurance program was operating in a negative deficit, and Congress said we have to bring that up into the black because we're currently in the red, so let's figure out how to make this work. And one of the ways they did that was they started to increase rates. At least that's long story short. And what happened was consumers saw that their rates were literally doubling or tripling overnight when their flood insurance policies would come due for renewal. This caused a number of problems. Again, long story short, what ultimately happened was that some consumers have found that forced place coverage through their financial institution is significantly less than it costs them to get their own private policy. I talked to one banker recently. They said that forced place coverage was about 1/3 the cost of the private policy for a customer that wanted to deal with forced place coverage. Now, it's okay for a financial institution to have forced place coverage, but it's been a general consensus that you cannot make, increase, renew, or extend a loan with forced place coverage. Each consumer has to have their own private policy, a voluntary policy per se, in order to do the loan. That's just been the rules for some time. So what's ultimately happened is we have consumers who have an existing forced place policy because they had a policy, they let it lapse, and then the bank would force place, but now they want to maybe refinance their loan. And they don't want to have their own private policy that costs 3 times as much. They're not willing to get their own private policy, so what happens? So the question becomes, can a bank close a loan with a forced placed insurance policy in place? So for us, it's a little bit difficult because the rules for flood insurance have been a moving target over the last while. It used to be that we had clear guidance on this. The guidance was the mandatory purchase of flood insurance guidelines from FEMA. And in this guidance, it specifically stated that forced placement of coverage is designed for use at any time during the term of a loan in uninsured and underinsured situations. Then it goes on here, and this is key. It says it is not intended for use at loan origination. It expands by saying if a borrower refuses to obtain flood insurance coverage as a condition of obtaining a loan, the loan is deficient and is not to be made. So the bottom line there is FEMA has always said you should not be making loans with forced place coverage in place. The consumer has to have their own voluntary policy. Now, if it lapses later, you could force place, but to make a loan, then you would have to do that. So the question then becomes is, does this apply to make, increase, renew, and extend? Or is it just making a loan? Or what cases would this apply? Now, the general consensus over the years was pretty much shouldn't do any loans with forced place coverage, but we saw that the FDIC has given informal guidance to their examiners, and we even heard this on a webinar a couple years back, that it is okay to allow forced place coverage to renew a loan, basically refinance a loan that's already with your bank. So if your bank has a loan that's already got forced place coverage, some examiners have said it's okay to go ahead and renew the loan. The problem is that guidance is not written down anywhere. I've not been able to find it. If you have, let me know, but I've not been able to see it written in any formal guidance. So what is the conservative approach? Well, of course, the conservative approach is going to be to just require a individual policy for every loan that has flood insurance and not to close any loans with forced place coverage. So that's the key, is you probably want to require this. Otherwise, what you should do is get something in writing from your examiner. your primary regulator, whether that's the Federal Reserve, the OCC, the FDIC, the NCUA, or even the CFPB, get something in writing to say that that's permitted. But the problem is, you're going to have to also cross your fingers because your auditors and other examiners may disagree with that approach. So that's our topic for today. I hope I don't make too big of a splash in your bank on this topic, but until next time, my name is Adam Whitmer. I hope you enjoyed this. Check out our resources at compliancecohort.com. If you're not a member, go ahead and subscribe. We have a lot of videos just like this. And until next time, I hope you have a great day. Thanks for watching.